All right, ladies and gentlemen, our next presentation is by our youngest speaker here today. The topic for this session is dynamic asset allocation in the new age of passive and quaint investing. Our speaker for this session is Mr. Siddharth Vora, Fund Manager, PMS and Head, Quant Investment Strategies, Prabhudas Lilidhar. Mr. Siddharth Vora heads quantitative investment strategies and is a PMS fund manager at Prabhudas Lilidhar. Siddharth joined PL in 2016 and has since spearheaded Prabhudas Lilidhar's foray into quantitative asset management. He was also instrumental in driving the new age advisory business for Prabhudas Lilidhar group prior to his move to funds management within the group. Siddharth is a chartered accountant, a CFA charter holder, and an MSc in Management for Business Excellence with a double diploma in World Politics from University of Warwick. In this session, profit from being at the right place at the right time will be discussed. Understand how dynamic asset allocation strategies relying on quantitative analysis and passive approach is relevant in the fast-paced world. Ladies and gentlemen, can we please welcome Mr. Vora up on stage?
So thank you so much, everybody, and thank you so much, PMS Bazaar, for giving me this opportunity to present myself and the strategy I'm going to talk about. It's a total honor to speak amongst some of the industry stalwarts that we've learned so much from over the last 5-6 years. I'll straight get into the topic. So I'm going to talk about how asset allocation is the significant driver of returns across investment cycles. And as we can see right here, 91.5% of investment returns are attributable to the asset allocation decision, which means if we are in the right asset at the right time, 90% of our job is done. And we can also see between 2006 to 2020 how the different asset classes have performed. And every year, the winners and the losers keep changing. Gold is outperforming in a certain year. Small caps are outperforming in the next year. Mid caps are outperforming the year after. So the idea to generate sustainable, stable returns with minimum volatility, the answer to that is significantly focus on asset allocation. There are two kinds of asset allocation that we can talk about. One is tactical asset allocation and the other is strategic asset allocation. Strategic asset allocation focuses on risk profile of individual investors, not on risk management per se. Tactical asset allocation is opportunistic in nature and focuses on risk management at a security or asset class level. Strategic asset allocation also is static in nature. So if I decide a 40% equity, 40% debt and 20% gold allocation, then I have to ride that allocation through the cycles. Whereas in tactical asset allocation, I can actually take opportunistic bets and focus on managing risk through the market cycles. Another important data point that we must focus on is over the last 1, 3 and 5 years, we've seen some of the actively managed funds underperform the passive benchmarks with a huge extent. So the data tells us that over a 5-year cycle, 82% of actively managed funds have not been able to outperform their passive benchmarks. So that makes a case for passive investing. I'll now talk about some of the global and domestic trends that we are seeing within the investment AUM that is now coming in. So passive goes massive. So that's the theme around the world. So now we see that 7.9% of AUM as of April 20 was in passively managed funds. 1.5 years later, that number is now at 11.9%, which means there is a huge shift. We also see that this is US data. In 1998, only 11% of the total AUM was under passively managed schemes. As of 2019, it's now grown to 50%. It's also important to understand how quant as an asset class has increased over the last 2 decades. So as of 2010, 1% of top hedge funds in USA used quantitative methods. Coming to 2019, 23% of hedge funds are now using quantitative methods for their investment decision making. We also see a small trend like this happening in India. So 2016 had 250 crores of assets in quantitative schemes. Coming to 2021, we're now at 7,300 crores. I agree the base is low, but the growth is meteoric. Another thing to see is that over the last decade, quant schemes, quant mutual funds in the world are growing at a 19.2% CAGR compared to active funds that are growing at about 1.5% CAGR, which is clearly showing how unbiased database decision making is paving the way for quantitative investments. It's also important to understand that as of today, the availability and access to data, to technology, and to the talent that can make use of this for investment decision making, all of it is growing in a huge way. And therefore, quantitative investing is going to be one of the key tenets of investing for the next 2 decades. And this summarizes everything that I was presenting so far. So the yellow bar tells us about actively managed assets. The light blue bar talks about passively managed assets. And the dark blue bar talks about the growth of quantitatively managed assets. So the trend across 1 year, 3 year, 4 year, and 7 year is pretty clear that actively managed funds are losing market share to passively managed funds, and quant funds are actually the fastest growing class within investment management. Now, why do I tell you all of this? Is obviously because I want to pitch what I have created over the last 3.5 years at Prabhudas Leeladhar. So the idea here is we have created a PMS strategy that blends asset allocation, passive investing, and quantitative methods. So multi-asset dynamic portfolio, we also call it MADP, invests across 7 different asset classes. It's not a long-only equity strategy, uses quantitative methods for decision making, and takes exposure to the different asset classes only through passive instruments such as index funds or ETFs. The 3 key tenets of our strategy are protection, participation, and performance. By protection, our focus is on minimizing downside risks when we are entering a bear market. Participation is when the equity outlook is good, we try to participate aggressively. And because we do this using quantitative methods, there is a higher predictability and consistency in our decision-making frameworks. We also need to understand that when we are talking about a quant strategy, we use 3 sets of data, which means we look at fundamental data, we look at alternative data, and we look at technical data. All of that is processed using quantitative methods, as against using only fundamental data, discretion, or experience to make decisions. Another thing to understand is that this is coming in as a SEBI-regulated PMS. A lot of mutual funds also exist in the multi-asset category, but with mutual funds come taxation constraints that they have to maintain a 65% odd equity allocation to be classified as an equity fund and obviously get the tax benefits. Under a PMS scheme, we do not have this constraint, so we can actually benefit from pure tactical asset allocation. And what do I mean by that? We can take our equity exposure all the way up to 80% and bring it down all the way down to 16% also. And over the last 1.5 years, while testing the product, we've seen that we could protect the COVID correction very nicely as we were out of equities from 78% to 16% in the second week of February. These are the asset classes that we invest in. So we invest in domestic large caps and mid caps via index ETFs. We also invest in gold. We also invest in 3 fixed income products: corporate bonds, government securities, and liquid funds. We also have exposure to international equities through the NASDAQ and S&P 500 index fund or ETF. Now, the idea for having domestic equity is obviously to capture growth. The idea for having gold is a hedge against inflation. The idea of having fixed income is to provide stability to the portfolio, and US equities provide exposure to technology as an asset class, which as of today does not particularly exist in India. And that is why all of the different asset classes are uncorrelated and play a significant role in managing portfolio risks and return. This is the most important part of the strategy. This is the quantitative model that we've worked on for the last 3.5 years before bringing it to all the investors out there. So our research showed us that managing asset allocation is all about identifying inflection points in asset class cycles. To be able to identify inflection points in asset class cycles, we have identified 9 different variables that have a significant impact on asset allocation. Our variables range from the economic cycle, the monetary cycle, the equity market cycle, the trend across asset classes, technical risk reward, sentiment in the markets, relative valuations, and global risk appetite. For each of these variables, we've coded something called a meter. So to track the economic cycle, we use a proprietary tool called Macrometer. Macrometer tracks 25 internal indicators to give us an output on where the economy is going and what is the current regime of the economic cycle. Similarly, economic cycle alone is not enough to give you a view on asset allocation. Therefore, we need a cycle that is faster than the economic cycle. And the second cycle we use is the monetary cycle. Monetary cycle is now being used with a monetary meter. The monetary meter again tells us more about interest rate regime, liquidity, money supply, and duration management within the bonds that we use in the portfolio. Coming to the third cycle, which is faster than the previous two, it's the market cycle. In market cycle, we use valuation zones to gauge where we are in a particular market cycle. Our tool, Cyclometer, helps us understand whether we are in a highly overvalued zone, fairly valued zone, undervalued zone, or a deeply undervalued zone. Over the last 45 days, we have been getting signals that we've been in a highly overvalued zone. With the recent correction and volatility that we've just seen, we've just about come to the overvalued zone from the highly overvalued zone. The next tool we use is the multi-asset momentum meter. We use dual momentum, which means absolute and relative trend across asset classes. Absolute momentum means I'm saying Nifty is up 10%. Relative momentum means Nifty is up 10%, mid caps are up 40%. So on a relative basis, Nifty is still underperforming. And that is why tracking both sides of momentum is extremely crucial for capturing trends within the different asset classes. The next meter we use is the gold meter. The gold meter helps us evaluate whether we should be investing in gold or should be ignoring gold completely. It doesn't have a purpose beyond the gold allocations. Technometer captures 2 critical aspects of technical analysis that have an impact on asset allocation. The first being reversals and the second being breakouts. So from the entire universe of technical analysis, reversal and breakouts are the only 2 things that matter to us for asset allocation. We try to capture a buy or sell signal across the different asset classes using our technometer. We've also captured sentiment by creating a proprietary indicator called Centimeter. We use 25 different daily leading indicators to understand where the market sentiment is headed on an ongoing basis. We also use relative value meter. So relative value meter is only used to add beta to the portfolio. When do we add beta to the portfolio? When we want to increase allocation to mid caps. So when mid caps or small caps are relatively undervalued as compared to large caps, that is when it provides an opportunity to enter mid caps. Obviously, we enter if it is supported by the other signals and meters that we've created. The last and one of the most important tools we use is the global roto. So global roto tracks the financial risk appetite across the world. So we use 26 different assets and we track them on a daily basis to understand whether the financial world is in a risk on mode or the financial world is in a risk off mode. To give you a small example of what a global roto indicator could look like is, if copper is doing better than gold and silver, that's a risk on indication. Similarly, if emerging market mid caps are doing better than developed market large caps, that is again a risk on indicator. Like that, we track signals across commodities, crude, cotton, lumber, copper, emerging market equity, developed market equity, emerging market and developed market fixed income securities. The idea is to get a simple indicator whether we are in a risk on or a risk off mode. None of these meters are used in an isolated manner. All of them are combined to give us the final output on asset allocation. This is completely automated, rules-based and data-driven, and there is no real human intervention except actually placing the order. I'll talk about the returns of the strategy now. So if we evaluate the strategy, so 2007 to 2019 is all back-tested returns. 2020 to June 2021 was a live test in our prop book, and we just recently launched the strategy with SEBI regulations under the PMS ambit in July. So the important thing is to understand how my returns could play across the different asset class cycles. The 2007, 8, 9 cycle is extremely important because in 2007, we are underperforming equities by a significant margin with a 35% absolute return, which on its own is pretty good, but relative to the different asset classes is underperforming. But 2008 is very important because we still deliver a positive 22.9% return, even when the equities have completely eroded north of 50%. 2009, we've participated aggressively with an 80% plus return in line with equities. 2010 to 14 is an important cycle again, where we have participated and protected in a good balance. 2011, when the equities have underperformed, we've delivered a positive 4.6% return, therefore helping stability in the portfolio. 2015 has been the worst year across the last 16 years, where we've delivered a 0.7% return, though not great on an absolute basis, is still protecting capital for investors in a bad year. 2016 to 19, we've outperformed broadly all the asset classes, and 2020 has been a stellar year because of COVID, the opportunity that COVID has given to a multi-asset scheme to play on both sides of the market cycle. Another important thing to understand and base investment decisions is also understanding rolling performance, which means even if I ignore my calendar years, what are my scenarios if I take a 3-year or a 5-year rolling performance? So my best case scenario is a 47% across 3 years compared to equities that have probably given 27.8% in the best 3-year cycle. Similarly, my worst performance has been 7.3% compared to equities, maybe large caps, that have given a 4.7% negative in the worst 3-year cycle. It's also important to know that median and average performance gives a fair estimation of how this strategy could perform over the next 3-year, 5-year cycles. So our median is at 16.5 and our average is at 21.4, much higher than the peers that we are comparing ourselves to in terms of passive instruments. Our standard deviation at 11.3% is even lower than gold, which is 14.3. Standard deviation is a measure of risk and volatility. Lower the standard deviation, the lower drawdowns you experience as an investor in your portfolio. Our Sharpe ratio is at 2.2, which is really impressive for a multi-asset strategy. And our 5-year returns are also showing that the worst performance is 9.7% compounded across a 5-year cycle, and the median and average is at 15.8 and 19% respectively. Our 5-year standard deviation is even lower at 10.3%. So to understand the returns and how this strategy protects your capital, grows your capital, and creates wealth across market cycles, these 2 slides were extremely critical. This is more on performance, but I would just like to give, I have 2 minutes left. I'm going to quickly take you all through the different meters and how they look like. So this is a representation of the macrometer, and it tells us how the economy moves through the different regimes. Red indicating slowdown, yellow indicating recovery, light green and dark green indicating steady and strong growth respectively, and orange indicating deceleration. The most money is made in equities as an asset class, not when we are in the green zone, but actually when we are moving out of red into the yellow zone. So moving out of a slowdown into recovery is the best cycle for equities as an asset class. Similarly, if we look at Cyclometer, this breaks the entire market cycle into different valuation zones. We were just in the red zone over the last couple of months and now cooling off in the overvalued zone, as I previously mentioned. This is the relative value meter, which gives us a view on when mid caps and small caps become relatively attractive as compared to large caps. This is the multi-asset momentum meter. So what the chart on the right represents is, if I ignored every other meter and every other investment framework and simply created a momentum portfolio, I would still outperform the Nifty 50 by a huge margin. So every 1 month, if I change my portfolio as per dual momentum, this is how my chart would look. This is technicals, which captures technical risk reward. This is just a representation for Nifty 50. Like this, we have for every other asset class. This is centimeter. So the blue zones indicate when we were invested in equities, and the yellow zones indicate exit signals out of equities. This is, again, as I said, one of the most important meters, the global roto. This tells us that since 2006, broadly, we've been in a risk-on mode with small patches of being in a risk-off mode. Now, all of these meters are actually combined and integrated using not a mathematical model of average scores, etc. We use an intuitive, logical model to decide how these allocations are to be done. Again, this is not as per the fund manager's discretion. The whole allocation process is coded. And I think my time is up, but I've taken you all through where we invest, what's the methodology, what is the framework, and how the returns have been. For anything else, we can probably take it offline post the event. Thank you so much, everyone, for the attentive listening.
Ladies and gentlemen, can you please put our hands together?